The bear case for Verizon: structural headwinds, saturated markets, and legacy liabilities. The bearish thesis for Verizon focuses on the permanent impairment of the cable and telecom sectors, the massive debt burden, and the potential for multi-billion-dollar legal liabilities. The U.S. mobile market has entered a harvest and retention phase, where gains are increasingly difficult to achieve in a saturated landscape. While Verizon's Q4 2025 results were strong, critics point out that wireless service revenue is expected to be approximately flat in 2026 as the company transitions to a volume-based growth model. This suggests that the cost of acquiring new customers remains high, potentially pressuring long-term margins. Furthermore, Verizon no longer holds the undisputed title for network quality. T-Mobile has effectively closed the gap, winning multiple awards for reliability and download speed. Network Quality and Performance January 2025 report. Reliability experience: Verizon tied for the win with 898 points, alongside T-Mobile. Download speed: Verizon recorded 46.0 megabits per second, trailing T-Mobile 158.5 megabits per second and AT&T 53.3 megabits per second. Coverage experience: Verizon won outright with a score of 9.6 out of 10, with AT&T in second place.
The lack of a clear network advantage means Verizon may be forced to rely more on pricing and promotions to maintain its subscriber base, which is a risky strategy in a high-inflation, high-interest rate environment. Verizon's balance sheet remains a significant concern for bear case analysts. Total unsecured debt stood at $131.1 billion at the end of 2025, and total debt, including secured obligations, was significantly higher. The Frontier acquisition, while strategically sound, added another layer of debt and increased the net unsecured leverage ratio by approximately 0.25x. The company spent $6.6 billion on interest expenses over the previous 12 months. As legacy debt matures, Verizon will be forced to refinance in a higher rate environment than when the debt was originally issued. Even if only a small portion of the debt is due in the near term, the incremental increase in interest costs will act as a persistent drag on free cash flow and EPS growth. One of the most significant black swan risks for Verizon is the ongoing controversy surrounding legacy lead-sheathed cables. An investigation by the Wall Street Journal in 2023 highlighted thousands of miles of abandoned lead-covered cables that may be contaminating soil and water.
Remediation costs. New Street Research has estimated the industry-wide remediation cost at $10 billion to $26 billion, with Verizon's share potentially reaching $1 billion to $4 billion. Active litigation. Verizon is currently facing numerous class action lawsuits from utility workers who developed chronic illnesses and from investors who claim the company failed to disclose the risks. Regulatory risk. Federal and state regulators, including the EPA and the New York Public Service Commission, are increasingly pressing for comprehensive mapping and soil and water testing. While Verizon management has stated that the risk of lead exposure is low and that the affected copper networks are relatively small, the possibility of multi-decade litigation and remediation costs remains a major psychological and financial overhang on the stock. While the OBBBA provides tax benefits, it also creates a mandatory spectrum pipeline that could force Verizon to participate in expensive new auctions. The bill requires the auction of at least 800 megahertz of spectrum, including 100 megahertz in the upper C-band by 2027. Some analysts warn that carriers may be trapped in a debt-fueled spectrum line grab for assets that have diminishing marginal value. One Wall Street estimate suggests carriers could spend more than $200 billion on spectrum auctions by the end of 2028, potentially diverting capital away from shareholder returns and fiber expansion.
The bull case: the transformation of an incumbent into a high-margin techco. The bullish thesis for Verizon is predicated on the belief that the market is underestimating the power of owner economics in a converged network and the significant financial tailwinds provided by the completion of the 5G build-out. Verizon's 2026 guidance suggests a significant departure from its historical performance. For the past decade, earnings per share grew at a pedestrian rate of 1.6% per year. However, the company is now projecting 2026 adjusted EPS of $4.90 to $4.95, implying year-over-year growth of 4 to 5%. This acceleration is driven by three primary levers: the realization of the $5 billion OPEX savings target, a $4 billion reduction in combined capital expenditures following the Frontier close, and the sustained growth of high-margin wireless and broadband services.
The underlying financial health is evidenced by the company's cash flow generation. In 2025, Verizon produced $20.1 billion in free cash flow, providing 1.7 times coverage of its dividend. For 2026, this is expected to rise to $21.5 billion or more, the highest level since 2020. This cash flow provides the flexibility to simultaneously fund a 20th consecutive annual dividend increase, pay down debt, and execute a new $25 billion share repurchase authorization.
The acquisition of Frontier Communications is the strategic centerpiece of Verizon's broadband strategy. By integrating Frontier's assets, Verizon now addresses more than 30 million fiber passings across 31 states. The rationale for this move extends beyond mere subscriber acquisition. It is about convergence. Households that bundle mobility services with fiber internet exhibit significantly lower churn rates than those with standalone services. Verizon plans to add at least 2 million new fiber passings in 2026, with a medium-term goal of reaching 40 to 50 million passings. The integration is expected to unlock over $1 billion in run-rate cost synergies by 2028 through network integration, contract consolidation, and go-to-market efficiencies. This scale allows Verizon to compete more effectively with cable providers like Comcast and Charter, who have been encroaching on the wireless market through MVNO agreements. Verizon's fixed wireless access product has emerged as a robust competitor in the residential and business broadband sectors. The company reported 319,000 FWA net additions in the fourth quarter of 2025, bringing its total base to over 5.7 million subscribers. The bull case argues that FWA is not a temporary gap filler, but a high-margin service that leverages existing 5G infrastructure with minimal incremental cost. Management believes they are on a clear path to reaching 8 to 9 million FWA subscribers by 2028. With the C-band deployment 90% complete and now covering 300 million people, Verizon has the capacity to support this growth without compromising mobile network performance. This capacity is further bolstered by targeted densification and the refarming of existing spectrum layers.
The One Big Beautiful Bill Act, signed into law in July 2025, provides a substantial but often overlooked benefit to Verizon's capital-intensive business model. Specifically, the permanent restoration of 100% bonus depreciation under Section 168K allows Verizon to immediately deduct a full cost of its network equipment and infrastructure investments in the year they are placed in service. This tax treatment acts as a massive tailwind for free cash flow generation. By reducing taxable income, Verizon can reinvest more capital into fiber expansion or use the savings to accelerate its debt repayment schedule. The OBBBA also restores full business expensing for domestic research and development, incentivizing the company's AI-first transformation and the development of private 5G solutions for the enterprise market. Company overview. The telecommunications landscape in early 2026 is characterized by a definitive shift from the capital-intensive infrastructure build-out phase of fifth-generation 5G networks to a sophisticated harvest and optimization phase. The appointment of Dan Schulman as Chief Executive Officer in October 2025, succeeding Hans Vestberg after an 8-year tenure, signaled a strategic departure from an engineering-centric philosophy toward a model prioritizing digital transformation and fiscal discipline. With the $20 billion acquisition of Frontier Communications officially closing on January 20, 2026, Verizon has effectively doubled down on fiber to the premises, FTTP, as the foundational bedrock of its future growth, aiming to integrate 30 million fiber passings with its national 5G footprint to create a comprehensive, converged network.
Management has categorized 2025 as a critical inflection point where the company's transformation began to yield results. In the fourth quarter of 2025, Verizon reported 616,000 postpaid phone net additions, its best quarterly performance since 2019. This was achieved while simultaneously implementing a workforce reduction of approximately 13,000 positions and identifying a $5 billion war chest of operating expense, OPEX savings for 2026. This strategic realignment is intended to ensure that volume growth and profitability growth occur simultaneously, rather than being mutually exclusive. A granular analysis of Verizon's segments reveals a tale of two businesses, a robust consumer mobile division and a struggling business wireline unit. Verizon Consumer Group, VCG. The consumer segment is the primary engine of the company,
generating $26.1 billion in revenue in the third quarter of 2025, a 2.9% year-over-year increase. Consumer wireless service revenue grew by 2.4%, driven by a 2.0% increase in average revenue per account, ARPA, to $147.91. Despite a saturated market, VCG has managed to keep postpaid phone churn low at 0.91%, a testament to the stickiness of its premium plans and bundled offerings.
Verizon Business Group, VBG. In contrast, the business segment continues to face headwinds from the secular decline of legacy wireline services. Total VBG revenue was $7.1 billion in the third quarter of 2025, a 2.8% decrease year-over-year. While business wireless service revenue grew slightly by 0.7%, it was more than offset by the weakness in traditional wireline revenue. Verizon is attempting to offset this decline by focusing on high-growth areas like private 5G and enterprise broadband, but these initiatives have yet to fully replace the lost legacy revenue. While Verizon remains competitive in ARPA and churn, it has trailed both AT&T and T-Mobile in net subscriber additions, particularly in the FWA and mobile phone categories. The Q4 2025 surge to 616,000 adds for Verizon is a significant development, as it suggests the company is finally beginning to close this growth gap. The convergence of 5G and fiber, the national strategy. The Frontier acquisition is the final piece of Verizon's national fiber strategy. Management envisions a future where the distinction between home internet and mobile internet disappears. By controlling the fiber backbone, Verizon can deliver multi-gigabit speeds to the home and then use that same fiber to backhaul 5G traffic from small cells and towers, creating a highly efficient, high-capacity network. By migrating customers from legacy DSL or competitor cable lines to their own fiber network, Verizon significantly improves its margins. Fiber networks have lower maintenance costs than copper and higher reliability, which further reduces churn. This owner's advantage is critical for defending against cable companies like Charter and Comcast, who currently lack their own national wireless infrastructure and must pay wholesale rates to Verizon or other carriers to offer mobile service. Verizon is already preparing for the next decade of connectivity. CEO Dan Schulman has emphasized that the company is becoming AI-first, deploying artificial intelligence to optimize network traffic, personalize customer offers, and automate maintenance. This is viewed as essential for managing the increased complexity of future 6G networks and the massive data demands of emerging AI applications. Valuation. As of February 2026, Verizon stock is trading near 9.5 times forward earnings, which represents a value play compared to the broader technology sector. Institutional investors, including BlackRock and Vanguard, remain top holders.
Conclusion. The investment case for Verizon Communications Inc. in early 2026 rests at a critical crossroads. The bull case is supported by a fundamental strategic pivot under new leadership, the successful completion of the Frontier acquisition, and the emerging financial benefits of a scaled, converged network. The completion of the 5G capital expenditure cycle, combined with significant tax tailwinds from the OBBA, has positioned the company to generate record levels of free cash flow, which can be used to drive both debt reduction and aggressive shareholder returns. However, the bear case is anchored by the reality of a saturated market and the persistent weight of legacy liabilities. The debt load remains immense, and the potential for a multi-billion-dollar lead cable settlement continues to act as a significant overhang on the stock's valuation multiple. Furthermore, the competitive threat from T-Mobile and AT&T, as well as the encroaching cable companies, means that Verizon must execute its convergence strategy with near-perfect precision to maintain its market leadership.